Imagine building your entire life on borrowed money. Not just a house or a car, but everything. Your income, your savings, your future. Now imagine that every time you try to get out of debt, the system forces you deeper into it. It sounds unstable, it sounds dangerous, but this isn't a personal story. It's how the global economy actually works. This is Money Records *, where money, power, and history connect. And once you see the system clearly, it's hard to unsee it. Because debt isn't just part of the economy. It is the economy. Right now, the world carries more than $300 trillion in total debt. That's nearly 3 times the size of everything the planet produces in a year. And yet, instead of slowing down, the number keeps rising. Every day, governments borrow more. Banks lend more. Markets expand further. On the surface, it looks like a growing problem. But here's the uncomfortable truth. If the world stopped borrowing, the global economy wouldn't stabilize. It would break. That sounds backwards, but it's exactly how the system is designed to function. To understand why, we need to step away from modern finance for a moment and go back to where this idea began. Long before stock markets, before digital banking, before central banks, governments faced a simple limitation. They ran out of money. In the past, power depended on physical resources, gold, silver, land. If a kingdom wanted to fight a war or expand its influence, it needed wealth up front. But wealth was limited, and wars were expensive. So rulers turned to a different solution: borrowing. Instead of waiting to accumulate resources, they asked wealthy merchants and financiers to provide money immediately in exchange for something powerful. A promise. Not just any promise, a structured, repeatable promise backed by future taxes. This changed everything. For the first time, governments could spend money they didn't yet have and spread the cost into the future. Even more important, those promises could be traded. If you held a government promise, you didn't have to wait for repayment. You could sell it to someone else. Debt became liquid, portable, marketable. And slowly, a new system formed. Countries realized they didn't need to rely purely on existing wealth. They could operate on expected wealth. Not what they had, but what they believed they would have. And that belief became the foundation of modern finance. Fast forward to today, and that same principle has expanded beyond anything those early lenders could have imagined. Governments don't just borrow in emergencies anymore. They borrow continuously to fund infrastructure, to support economies during downturns, to stimulate growth during slow periods, to stabilize financial markets during crises. Debt is no longer a backup plan. It's the primary tool. And here's where things get interesting. When governments borrow money, they don't usually plan to pay it back in the way most people think. They don't set aside funds to eliminate the entire debt. Instead, they manage it. They roll it forward. Old debt is replaced with new debt. Bonds expire, and new bonds are issued to cover them. Over and over again. This process is called refinancing. But in practice, it means something very simple. The system depends on continuous borrowing. Think of it like a moving walkway at an airport. As long as you keep walking, everything feels smooth. But if you stop, you lose balance instantly. The global economy works the same way. Movement is stability. Stillness is risk. That's why even the most powerful economies in the world continue to expand their debt. The United States carries tens of trillions. Japan's debt is even larger compared to its economy. European nations continue to borrow at massive scale. Not because they've lost control, but because stopping would create shockwaves across the entire system. But this leads to a deeper question. If governments are constantly borrowing, who is providing the money? At first glance, the answer seems simple. Investors, banks, pension funds, insurance companies, foreign governments. And that's true, partially. But when you look closer, the picture becomes more complex. A large portion of government debt is held domestically. That means countries are, in many ways, borrowing from their own financial systems. Money flows in cycles. Governments issue bonds. Institutions buy those bonds. Interest is paid using tax revenue. That interest flows back into savings accounts, retirement funds, and investments. The money moves, but it rarely leaves the system. It circulates. And then there's another layer: central banks. These institutions sit at the core of modern finance. And their role is often misunderstood. They don't just regulate money, they create it. When a central bank buys government bonds, it doesn't take existing money and move it around. It generates new money, digitally. That means new currency enters the system in exchange for debt. And that leads to one of the most important realities of the modern world. Most money exists because something was borrowed, not saved, not mined, not printed in the traditional sense. Borrowed, which creates a strange dependency. If borrowing slows down significantly, money creation slows down. And when money creation slows down, economic activity weakens. That's why reducing debt too quickly can actually harm an economy. Less borrowing means less spending. Less spending means less income. Less income means more pressure on the system. It's a chain reaction. This is why governments aim for a balance, not elimination. They don't want debt to disappear. They want it to remain stable, predictable, and manageable. Because stability is what keeps confidence alive, and confidence is what keeps the system running. As long as investors believe that governments can continue servicing their debt, paying interest, rolling it forward, the system holds together. But belief is fragile. History has shown what happens when it breaks. In certain countries, rising debt combined with falling confidence triggered rapid crises. Borrowing costs surged, currencies weakened, access to funding disappeared. And when that happens, governments face hard choices: cut spending, raise taxes, seek external support. The consequences ripple through entire populations. Jobs are lost, prices rise, economic growth stalls. In those moments, debt stops being abstract. It becomes real. But even in those situations, the system doesn't disappear. It adapts. Debt is restructured. New agreements are formed. Old obligations are extended. And eventually, the cycle resumes. Because modern economies are not built to function without debt. They are built around it, like fuel in an engine. Remove it, and everything stops. But there's another dimension to this system, one that operates quietly in the background. Debt doesn't impact everyone equally. While nations may appear to owe money collectively, the internal flow of payments tells a different story. Interest moves in one direction, from borrowers to lenders, from governments to investors, from taxpayers to asset holders. And over time, this creates imbalance. Those who own financial assets, bonds, securities, investments, benefit from the system. They receive consistent returns. Those who don't contribute through taxes, inflation, and economic pressure. This dynamic exists at every level. Within countries, between countries, across the global system. So while debt keeps economies functioning, it also reshapes how wealth is distributed. And that's why rising global debt often exists alongside rising inequality. Not because the system is broken, but because it operates in a specific way. It rewards participation at the top and places pressure toward the bottom. That doesn't make creditors villains or borrowers victims. They are both necessary parts of the same structure. But it does highlight an important truth. The system isn't neutral. It has direction, and that direction matters. So when people ask, who does the world owe all this money to? The answer isn't simple. It's not just foreign nations. It's not just financial institutions. It's a network of relationships, layered, interconnected, constantly shifting. In many cases, countries owe money to their own systems, to their own citizens, to their own institutions, and at the same time, they are owed by others. It's a web, a structure where everyone is both connected and dependent, and that dependence creates stability, but also risk, because the system works as long as the flow continues, as long as borrowing meets expectations, as long as payments are maintained, as long as confidence remains intact. But if that confidence fades, even slightly, the effects can spread quickly. That's the real nature of global debt. It's not just numbers on a balance sheet. It's trust, quantified. It's belief, measured in trillions. And it only works because people accept it. Because they believe governments will continue paying, continue borrowing, continue sustaining the system. But at its core, debt is still what it has always been. A promise about the future. And like all promises, it depends on one thing above all else: credibility. As long as that credibility exists, the system can expand. It can evolve. It can sustain itself far longer than it seems possible. But if that credibility is ever lost, the system doesn't slowly unwind. It changes, quickly, and completely. Because when trust disappears, the structure built on top of it has nothing left to stand on. And that's when the real question isn't just, who owes what? It becomes, what happens next? If this changed the way you see money, subscribe to *Nane Money Records. Because once you understand the system, you start to see the world differently.